Investing is often seen as a game of numbers, but what if we told you that your biggest opponent isn't the market, it's your own mind? The decisions you make, the risks you take, and even the moments you hesitate are all influenced by your mental state. Traditional finance theories often assume investors are perfectly rational. They suggest that we all make decisions based purely on logic and available information. However, behavioral finance, a growing field of study, recognizes the powerful role emotions play in our financial decisions. It acknowledges that our feelings can sometimes cloud our judgment, leading to choices that might not be in our best interest. Understanding these emotions and their potential pitfalls is crucial for making sound investment choices. By being aware of how our mind works, we can better navigate the complexities of the market. Think of your brain as having two systems. These systems are constantly at play, influencing every decision you make. System 1 is fast, instinctive, and emotional. It's the part of your brain that reacts without thinking, driven by gut feelings and immediate reactions. It's what makes you jump at a sudden noise. This system is essential for survival, helping you respond quickly to potential threats. System 2 is slower, more deliberate, and logical. It takes over when you need to think things through, analyze data, and solve problems. It's what you use to solve complex math problems. This system requires more energy and effort, but is crucial for making well-thought-out decisions. When it comes to investing, we need both systems working in harmony. Balancing the quick emotional responses of System 1 with the careful, logical thinking of System 2 can lead to better outcomes. However, the market's volatility and complexity often trigger System 1, leading to emotional decisions that may not align with our long-term financial goals. This can result in impulsive actions like panic selling during a market dip or buying into a bubble. The good news is that by understanding these emotional biases, we can develop strategies to mitigate their impact. Knowledge is power, and by educating ourselves, we can create a more disciplined approach to investing. In the following sections, we'll explore some of the most common emotional biases in investing and provide practical tips for making more rational decisions. Stay tuned as we delve deeper into the fascinating world of behavioral finance and uncover the secrets to mastering your mind in the market. Overconfidence, a common human trait, can be particularly detrimental in investing. It's the tendency to overestimate our abilities, knowledge, and the accuracy of our predictions. In the context of investing, overconfidence can lead to excessive trading, concentrated portfolios, and ultimately poor returns. Imagine someone who believes they can consistently time the market, buying low and selling high. They make a few successful trades and their confidence soars. They begin to take bigger risks, believing they have a special knack for picking winners. However, the market is unpredictable, and their luck eventually runs out. Research has shown that overconfident investors tend to trade more frequently, incurring higher transaction costs and often underperforming the market. They may also hold less diversified portfolios, concentrating their investments in a few stocks or sectors they perceive as sure things. This lack of diversification increases their exposure to risk. Loss aversion is the psychological principle that the pain of a loss is felt more strongly than the pleasure of an equivalent gain. This concept, rooted deeply in behavioral economics, explains why people often make irrational financial decisions. For example, losing $100 feels worse than the joy of finding $100. This disproportionate emotional response can cloud judgment and lead to poor decision-making. In investing, loss aversion can lead to irrational decision-making, such as holding on to losing investments for too long or selling winning investments too early. Investors might cling to a sinking stock, hoping it will bounce back, or they might hastily sell a rising stock, fearing an imminent drop. Imagine an investor who buys a stock that quickly drops in price. The initial reaction is often panic, followed by a refusal to sell at a loss. They hold on to the stock, hoping it will rebound to avoid realizing the loss. This hope can turn into a long-term hold, even if the stock continues to underperform. Meanwhile, they may miss out on other opportunities to invest in potentially more profitable assets. The fear of loss can paralyze decision-making, causing investors to overlook better options. Conversely, an investor driven by loss aversion might sell a winning investment prematurely, fearing that the price will drop and they'll lose their gains. This premature selling can prevent them from realizing the full potential of their investments. To counteract loss aversion, it's crucial to remember that short-term fluctuations are a natural part of the market. Understanding this can help investors stay calm during market dips and avoid making hasty decisions. Instead of fixating on daily price movements, focus on your long-term investment goals and the overall performance of your portfolio. This long-term perspective can provide a buffer against the emotional roller coaster of market volatility. Having a well-defined investment plan can help you stay the course during market volatility. By setting clear goals and sticking to a strategy, you can mitigate the effects of loss aversion and make more rational investment decisions. Section 4. Herd mentality. Following the crowd can cost you. Herd behavior, the tendency to follow the actions of a larger group, is a powerful social force that can influence our investment decisions. This phenomenon is deeply rooted in our psychology, as humans are inherently social creatures who seek validation and security in numbers. When we see a large group of people making a particular choice, it can create a sense of urgency and fear of missing out, often referred to as FOMO. When we see others buying or selling a particular stock, we may feel compelled to do the same, regardless of our own research or analysis. This can be particularly dangerous in the fast-paced world of investing, where decisions are often made in the heat of the moment. The pressure to conform can override our better judgment, leading us to make impulsive decisions that we might later regret. This can lead to asset bubbles and market crashes. When too many investors follow the crowd, it can inflate the value of assets beyond their true worth, creating a bubble. Eventually the bubble bursts, and the market corrects itself, often with devastating consequences for those who bought in at the peak. Think about the dot-com bubble of the late 1990s. During this period, investors were enamored with internet companies, many of which had little to no revenue. The hype around these stocks drove prices to astronomical levels, far beyond what the companies were actually worth. Investors piled into internet stocks, driving prices to unsustainable levels. The frenzy was fueled by the belief that the internet would revolutionize business and create unprecedented wealth. While this was true to some extent, the market's expectations were wildly unrealistic. The logic was simple. Everyone else is buying, so I should too. This herd mentality led to a massive influx of capital into internet stocks, creating a bubble that was bound to burst. When the bubble burst, many investors lost significant sums of money. The crash wiped out trillions of dollars in market value, and countless individuals saw their investments evaporate almost overnight. To avoid falling prey to herd behavior, it's important to be critical of market trends and popular investments. Take the time to conduct thorough research and understand the fundamentals of the assets you're considering. Don't let the actions of others dictate your investment strategy. Just because everyone else is buying a particular stock doesn't mean it's a good investment for you. Each investor has unique financial goals, risk tolerance, and time horizons, which should guide their decisions. Do your own research, consult with a financial advisor, and make decisions based on your own financial goals and risk tolerance. By taking a disciplined and independent approach, you can avoid the pitfalls of herd mentality and make more informed, rational investment choices. Section 5. Anchoring bias. Stuck on the first number. Anchoring bias occurs when we rely too heavily on the first piece of information we receive, even if it's irrelevant or outdated. This anchor can influence our subsequent judgments and decisions, including those related to investing. For example, imagine you're researching a stock and the first price you see is $100 per share. This price becomes your anchor. Even if the stock's fundamentals later deteriorate and its true value drops, you may still be inclined to view $100 as a fair price because you're anchored to that initial number. To mitigate anchoring bias, be aware of the power of first impressions. When evaluating an investment, seek out information from multiple sources and perspectives. Don't let the first number you see dictate your entire analysis. Section 6. Confirmation bias. Seeing what we want to see. Confirmation bias is the tendency to seek out, interpret, and remember information that confirms our existing beliefs, and to ignore or downplay information that contradicts them. This can be particularly problematic in investing, as it can lead us to make decisions based on our biases rather than on objective evidence. Imagine an investor who has a strong belief in a particular company. They may actively seek out news articles and analyst reports that support their positive view of the company while ignoring or dismissing any negative information. To combat confirmation bias, it's essential to actively seek out dissenting opinions and challenge your own assumptions. Consider the opposite viewpoint. What if you're wrong about this investment? By considering all sides of an issue, you can make more informed and objective decisions.